Good day, fellow investors. We are in full lockdown, which means only essential stores are open. So if you want to buy a drill, you can't buy it. So if you can't drill, it means that the economy isn't going forward, you can't work, people can't work, we can't go skiing, for example, if you're a skier this season. So the economy is in a bad place, but stocks keep going up. Over the past months, people have lost days just looking at how the elections will go without having any impact or influence. Plus, there is then the vaccine. Will it come? Will it be effective? Will it not be effective? But on the other hand, the COVID situation globally has really accelerated and became difficult so that we, as I said, are in lockdown, schools closed, everything is closed, and you can't work. And we have to see, okay, what will be the repercussion here, because the market just keeps going up and it's even higher than pre-COVID. So bad economy, terrible economy, but the market is 12% higher than where it was at the beginning of the year. So there are some other forces, not the economy, driving the market, and that's what we have to discuss and also try to assess what will happen next, what will be the future forces or the repercussions of the current forces. Why are markets going up? Well, it's all about the flows. There is plenty of money. The Fed, Central Bank of Europe, Bank of Japan have all printed money, injected that liquidity into the financial system. The financial system takes that money and pushes it into real assets, which are stocks. And if there are positive flows, like a record weak inflows to global stocks ever, if there are those positive flows, well, then stocks can only go up, which means that from an asset class perspective, the market and everybody is chasing stocks. And if you look at global wealth investment managers' asset allocation, you can see that it is at a historical low of 20.6% is invested in bonds. It was 34% in February 09 when nobody wanted to touch stocks. So it has been going down, down and down, and the more assets go from bonds to stocks, the higher stocks go. And I've discussed this by discussing Harvard professor Gabaix and Chicago Boot School Cohen theory of inelastic market hypothesis. I'll put the video link in the description below because that's a key video for understanding this market. 1 billion going from bonds to stocks increases the market value by 5 billion. And that's also the explanation, gives the explanation why is the market going up. The flows, simply 1 billion into the market pushes the market 5 billion. 1 trillion, 5 trillion. And that's why we are at record highs with stocks. If we look at bonds, so the global bond market is $115 trillion. 42 trillion in the US, developed markets, another 46 trillion, and a little bit less in emerging markets. But 42 trillion, if those, look at the investment options, so you can be invested in bonds, and if you look at the bond sector, if you look at the yields there, just look at the current yields in the bond sector. US 18, 16, 0.76 excluding the US. Japan 0.11 for investing in a bond, which means if you add inflation, that is a negative real yield. So there is no risk. There is only the certainty that you will lose money when the bonds ends up. So you are given certainty to lose money. And of course, logically, then people transfer from bonds to stocks. Who is covering for the bond outflow? Well, central banks. If we look at developed markets, central bank bond purchases, those are constantly going up, up and up. We are at 4.55 trillion, projected to be higher and higher. So Fed printing money, putting into the bond market, money exiting the bond market, going into stocks, is the reason why stocks are are at these very high levels. And to see what will happen next, we have to continue to follow those flows. And if global managers, pension funds keep switching from debt that has no yield to other asset classes like stocks, then the sky is the limit for stocks. That's one probabilistic scenario, one of the most probable scenarios out there for stocks. Also, not just monetary policy, fiscal support is huge. That is trying to balance out that economy. So 40.9% of GDP in Germany, also similarly in Italy, 15% of GDP in the US has been implemented into the economy as support. Those are huge numbers, but these are printed numbers. It's not that something is really going on into the economy there, which might have future repercussions. And when you look at the fiscal and monetary supports, you wonder, okay, what will be the future? What will happen after COVID, after stimulus, after free money? Well, deficits, inflation, unemployment, and other issues. When COVID passes, and it will likely pass in the next 6 months, 12 months, we will be concerned about other things. So let's start discussing that, and this is one chart that's very, very interesting. You have US debt. This is a linear chart, so it really puts things into perspective, but it's really going up, up, and up, and over the last, 4 decades, debt isn't an issue. So we have free money, and that might change in the future. So that might change, and that might lead to inflation. So we are now at very low inflation. Of course, I can't buy a new drill, nothing. So demand is low. This allows technology improvements, low costs, production in China. Free money lowers the production cost, the cost of capital. So everything looks good. But as always in economy, these things change sooner or later. And that's another worry we might have in the near future. Unemployment 7% in the US, 8% or something in the European Union. That's a lot different than 3%. There is no skiing, so these effects of a crisis, of a lockdown, will be felt over the coming years, which is another issue we might be concerned. Then something disrupting, something different, new technologies are being developed, everything is going online. That also might hit in a disruptive way the way we are living, because less demand for oil, less demand for travel, less demand for this, less demand for planes. That might be also an issue that we might be facing in the future. And then we have to, when it comes to investing, we have to see how all these trends impact our portfolio. How is our portfolio positioned for those trends? And then let's just discuss the market. Will the market go up or down? If we look at the valuation perspective, this is a great chart that I found. And if we look at the historical percentile of expensiveness for the market, all metrics are in the 90th to 100th percentile. So in the last 100 years, only in 9 to 0 years has the market been so expensive. So it's all in the red. Why is the market so expensive? Well, it's very simple. If bonds yield nothing, if you go to your bank and you get 0, then everything else is attractive. And the last 4 stocks that I have analyzed over the last few days all give good likely returns. So Amazon growing 10-50% from an investment perspective is likely. eBay 10% from a value investment perspective. RHI Magnesia that I looked at, London traded 8% cyclical, 10% cyclical likely return. Possible much higher returns. And then there are also, in the bad case scenarios, you'll get okay returns. Compare these bad case returns with bonds, and you get it that it's insane, irrational to be in bonds, and therefore stocks are still relatively, comparatively, very, very cheap if interest rates stay this low. And then it's about, okay, where do I want to be? Do I feel good with These levels, if you look globally, you can find, as I said, cheaper levels, 8% yield. That's a good yield, that's a good return. That gives you something interesting for the long term. So when it comes to what will happen next, more money will push stocks higher. We might see price earnings ratio of 60 like it was the case in Japan. We'll see what will happen with inflation, with businesses, and then at the end it's all about your strategy. What can you handle? That's something we'll discuss tomorrow, 2021 stock market crash title, but it will be more about an investing strategy and how to be ready for whatever happens. So it's all about your strategy. You have to think, okay, whatever the scenario is, how does my investing fit that scenario? Economic crisis, crash, am I ready to survive it personally? And then, am I ready to have something extra for living? Will I need to take out money in case of a crash, if in case of I lose a job? Well, then you have bonds. So it's not really crazy to have bonds if you need the money next year 100%. You want to protect that capital. And that is what investing is about. Not about projections and what can happen. It's about this is what can happen. How am I ready for any of the projections or probabilistic outcomes? That's the key when it comes to investing. And if you like that, subscribe, click that notification bell, click like, please, it helps the algorithm. If you like this video, you can check everything that I do on my website or in the links below, and I'll see you in the next video.